So here it is. This is what I think Microsoft is worth. This is based on 3 different valuation methodologies. It's based on a discounted free cash flow. It's based on an EV to EBITDA valuation and a price to sales valuation. So what is Microsoft worth? Keep watching, find out. Really appreciate watching this video, and I do want to remind you that this is not financial advice. This is just my opinion about what this stock is worth. Do your own due diligence because, let's face it, I'm not always right. What's up everyone, my name's Robbie, this is Robbie and Manila, and today we're doing a stock analysis of Microsoft. Jumping straight into this right now, what is the price to sales valuation that I have for Microsoft? Well, for the end of this year, 2022, my price to sales base valuation is $203 for Microsoft. That's what I think it's worth. Now, it's 32% overvalued right now, and by 2026, if you had bought this and held today until 2026, $336 is what I think it would be worth in 2026. That would only be a 2.34% rate of return. So based on this valuation methodology, I'm not loving Microsoft stock, but of course, we're going to go over some other valuation methodologies. Quickly, I'm just going to show you some of the inputs I put into this. I don't want to go too in-depth into this. I know you usually just like to see the outcome of what this shows you, but first off, I just have step 1, which is what are the shares outstanding. So I have Microsoft buying back shares 1% each year. Next, we have step 2, which is to find the sales growth. So what do I see on sales growth? Well, you see over 1 year, the sales growth has been 17.5%, over 3 years, 15%, over 9 years, about almost 10%. The median is 14 and the average is 13.8. So what did I do? I went with a declining sales. So 14% growth right now, this year, 2022, 40% next year, but then declining 2024, 2025, 2026, only having 10% growth in sales. This brings us to step 3, which is we need to find a sales multiple for Microsoft. So what do we have here? These are the different multiples that it's traded at the end of the years, going back a few years. So the average was 8.79, the median 8.25. It's currently at 12.33, so higher than its average over the past few years. So what am I thinking? I'm going with an 8 for the price to sales ratio. It's right there at the median and the average basically. So that is what I'm going with. That is $203 per share. This is a pivot table. This is showing a price to sales multiple of an 8. This is showing if it's a 6. This is showing if it's a 10, if it's a 12. So pick your flavor if you want to do that. So that's what I'm going with. I'm going with an 8. These are my numbers because of that. All right, let's go to the other valuation methodology. We have EV to EBITDA, which is enterprise value to earnings before taxes, interest, depreciation, and amortization. What do we have here? We have a selected target price for 2022 of $229, a little bit higher than the other one, 23% overvalued. This one shows it growing to $421 by 2026, so a bit of a better return, which is a 7% return over that time period. So what do we have here for our inputs? Just like our price to sales valuation, we have step 1, which is figuring out shares outstanding. Are they diluting us? Are they not diluting us? So they are not diluting us. They are buying back shares at 1%. Next, we have step 2, which is the EBITDA forecast. So what do we have here? I basically took some different years of EBITDA growth. These are different years, year 5, year 9, year 3, right? So the median of these is 20% growth and average is 19% growth. So I went with 20% growth in 2022, and I have it declining. So 2023, I have it at 18%, 16, 15, 12%, which I think is pretty conservative by 2026. Next up, we have step 3, so EV to EBITDA multiple. So in 2017, the multiple was 11.98. This is at the end of the year, end of 2017. That's when I got this number. 2018, 2019, 2020, 2021. Average was 17.5, median 16.6. What do I do? Well, I take a multiple that I think is appropriate. I just went with the average here. So between the average and the median, so I have a 17 multiple. That is this column. So in 2022, that shows a price target of $229 by 2026, $421. And that's basically where I got this. So this is a pivot table. If you want to have a different price to sales multiple than I used, well, You can use 17, you can use 22, you can use 12. So up to you. This is what I feel comfortable with, so I'm going to use this one and our weighted target price at the end of this. Next, we have one of my favorite things, which is the Cat 5 score. I created this. This is a scoring system that I feel like basically helps me figure out if a stock hits the right kind of like categories that I like to see. The first thing we have is the industry-based valuation. So we have PE ratio, forward PE, price sales, price of free cash flow. But what we do in this, which is different than a lot of other people in my opinion, is that I base all of these on deciles of the industry averages. So what does that mean? We're going to go and take a look real quick. I'm going to show you what that is so you understand how this works. So basically, in terms of the peers or the competitors of Microsoft, what I'm using are 229 different companies, and I'm taking all of their PE ratios here, and I'm saying, okay, first off, this is the average of the PE ratios, 175, really high. This is Microsoft's PE ratio, 32, right? The median PE is only 42 because there's some really high outliers out there with very high PEs. Of course, this is more tech-oriented industry, right? So what I talk about when I say deciles is, for example, if you're in decile 1, you are in the 10% cheapest PE ratio, the 10% lowest PE ratio. So if you have like PE of 1, a 2, a 3, you're probably going to end up in this decile 1. Decile 1 is where you want to be. Lower decile is going to be better. A decile 10 means you have the highest PE. So if a company falls in decile 10, it's got a PE over 186. That's a lot, right? So we don't want to be in decile 10. So we want to be in kind of the lower deciles in these systems. Okay, so I hope that makes sense. So here we have the PE ratio. So you want a lower decile. So decile 4 is good. This is a 32.31 PE ratio. And then that gives us a score of a 5, which is the highest score you can get. So here are the different scores that you can get. A 5 if you're in this decile, 2 in this decile, 0 points if you're in this decile. So this got 5 points. That's the highest score you can get for PE ratio. Forward PE ratio, we have 4th decile. This is the forward PE ratio, and it's got a 5, so that's good. That's the highest you can get. So price to sales ratio, it's in the 8th, so that's not that great. So 12.33 is the price to sales ratio, and that's actually going to give us a 0. We're not giving any points for price to sales. Price of free cash flow, it's a 6. It's actually at a 52, which seems pretty high, but that's actually in the 2nd decile for the industry, so that actually does good. Price of free cash flow, what we have here is decile 6, so right in the middle there. Not that great, but not too bad. 52 is the price of free cash flow. It gives us still 2 points. Next, we have the gross margin. So the gross margin for Microsoft is in the 5th decile. 68.80 is the gross margin, which you'd think is really good, but it's in the tech sector, so there's a lot of companies that have higher gross margins. You have a 2 points for that, so you get half points. Net margin actually is in the 1st decile, crazy high net margin, 42%, so that gives us a 5, so that's a full score. Best you can get for net margin. Then we have revenue growth. So revenue growth's in the 5th decile. It's 13% over the past 5 years. And that's going to give us 2 points, so half of a score. Earnings per share growth here, we have decile 2, so 25%, really great earnings per share growth, which gives us the highest score you can get, which is a 5. Free cash flow wise, I like to see free cash flow of more than 10%. I don't have data for deciles for this one. So this is around 21% over the past 5 years, really good free cash flow growth, really like that. So that's going to give us a 5 as well. Next up, we have liquidity score. So all I do here is I take a look at the debt to equity ratio, and we have 1.18. I just like this to be under 2. This is fine at 0.42, so totally fine, no problems here. We have a 5 full score here. F score, Piotrowski F score. If you have no idea what that is, take a look at my video on Piotrowski F score. Did a whole video on it, but what we want here is a 7, 8, or 9 for an F score. We have F score actually of an 8. So that's a score of a 5. So that's a full points, best you can get for a score there. Shares outstanding, we want them to be decreasing usually, depending on the company, but this company we want them to be decreasing, and they are. That gets a 5 as well, full score. Sorry, this should say decreasing, so I fixed that. All right, here we go. What is the Cat 5 score of Microsoft? Remember, over 70% is good. That is how I judge this. Over 70% is good. This score is a 48 points out of a total possible of 60 points, which gives us a 77% score. That's a good score. So real quick, where did it get good points? It got a 60 in the peer valuation, a 70 in the peer profitability score, an 80 in the peer growth score, 100 in liquidity, and 100 in Rolex. So this thing really just didn't do that well in the peer valuation score. Everything else looked pretty well. Now we're going to do a discounted cash flow using free cash flow, but I do want to just mention real quick that there is a small dividend paid by Microsoft. 0.8, I think, is the dividend yield, so not very high yield, but there's a bit of a dividend there. All right, so here we have the discounted cash flow. I'm using GuruFocus.com, by the way, to figure this out. So this is basically telling me $215 is what the stock is worth. It's 40% overvalued, so that's not a good thing, of course. What did I use here? I used a growth rate of free cash flow of 15% higher than it's been in the past 10 years. It's been 8.80 over the past 10 years, but over the past 5, it's been 17.50, up past year, 21. So I actually gave it a lot of leeway here, and I gave it a little higher growth rate than, probably than it's been over the past. So I'm actually probably being more aggressive on this. I'm still only getting a $215 price target for this company. Okay, here we go. This is what I think Microsoft's worth. Now, this is based on a weighting of those 3 different valuation methodologies we just went over. Why do we do this? Well, there's, of course, as you saw, they all have their own target price. They're kind of not all over the place, but there's definitely some differences, so we just weight them together. So 33% is free cash flow, so $215 target price for that one. 33% is price to sales valuation. That was only a $203 price target. And then EV to EBITDA valuation was 33%, or is 33% weighting. $229 was that one. That was the highest that it gave us out of the different methodologies. So this gives us a weighted average target price of $216, making Microsoft overvalued by about 29%. So for me right now, not necessarily a stock that I'd be, very much jumping into, but of course the company is amazing, and do I think it's going to grow over the long period of time? I do think so. But I probably want it to come down a bit more for myself personally on this one. Now let's take a look quickly at technicals. All right, so here we have a chart of Microsoft going back until the summer of 2019. Of course, like all stocks, many stocks, not all stocks, very nice uptrend channel, and of course. We know what happened in January of 2022. A lot of stocks fell down, broke down through their uptrend line. Let's zoom in real quick and see what's going on closer. So we actually have a very bad thing here. It's actually called a death cross. If you're not sure what that is, that's basically when the short-term moving average, so the 50-day moving average, crosses under the 200-day moving average. I'm going to take off the some of the things here, some of the drawings, and you can see this blue line. This is the 50-day moving average. It just crossed under this red line, which is the 200-day moving average. That's not a good sign for a stock. Usually, that is a point when I would not buy. I would definitely wait. So for me personally right now, just this thing is telling me that I'm going to wait. So the next thing I have here is what is the, there's some resistance essentially. This resistance goes back until August of 2021. There's a few points that it hit for resistance. So it's got some historical resistance in these areas. And this area that it's in is about $304. So I made this green so it's easier to see. So now we have, this is the uptrend channel, this is now the downtrend channel. What's going on here? Well, of course we could see that right now it's hitting some potential resistance, So if this does end up breaking up through here, then this downtrend channel, maybe it's not a big deal, but what probably is gonna happen, what I'm gonna just assume, based on what's going on with like death cross, is this thing is going to bounce off down, and it's going to go down further, and then this will consolidate a bit inside this downtrend line. We'll see what happens. So I wouldn't be buying this right now personally. For me, technically, if I like this long term, of course, if you're someone who just buys and holds, maybe you don't care about technical analysis, totally fine. RSI looks like it's stalling here, and then also MACD looks like it is potentially stalling. The oscillator got that little lighter shade green, which is not that good. So on technicals, not liking Microsoft right now. I would be waiting to see what happens in the resistance area that it's kind of at now and see what's going on with the death cross. That's all I have for this video. If you liked it, please hit the like button, subscribe to see more stuff like this when I publish it, and watch another of my videos. It's coming up in the end screen right now.